silver didn't just dip and bounce, it sent a warning shot across the entire commodities market, and almost nobody is talking about what that really means. Silver briefly surged toward the mid-60s on December 11 before abruptly sliding to the low 62 range in less than half a day. At first glance, it looked like a routine pullback after a strong rally. But when you dig beneath the surface, the price action starts to look far less ordinary. What's unfolding right now appears to be a stress test of the physical silver market itself, not just another bout of speculative volatility. Behind the scenes, data coming out of major silver vaults suggests something unusual is happening. Withdrawals from COMEX, registered silver inventories, have accelerated at a pace that doesn't resemble anything seen earlier this year. Several market watchers estimate the drawdown rate is running more than 100 times faster than the average daily withdrawals observed throughout most of 2024. If this trajectory continues, the system could be approaching critically low levels of deliverable silver much sooner than most traders expect, potentially within weeks, not months. This matters because registered inventory isn't just an abstract number on a spreadsheet. It represents the physical metal that backs futures contracts. When traders holding short positions are required to make delivery, this is the pool of silver they draw from. When that pool shrinks rapidly, pressure builds, and the risk of a delivery squeeze rises sharply. History shows that when physical availability tightens this fast, exchanges are often forced to react, sometimes in ways that change the rules of the game overnight. To understand why this moment is so important, let's rewind briefly. Between December 4 and December 8, publicly available vault data indicates that registered silver inventories fell from roughly the high 40 million ounce range to just under 20 million ounces. That's a reduction of nearly 30 million ounces in only 4 business days. For context, typical daily drawdowns earlier this year averaged closer to a couple 100,000 ounces. This recent move wasn't incremental, it was explosive. Imagine draining a massive reservoir, not with a pump, but with an industrial fire hose. That's the scale we're talking about. With the December futures contract expiration approaching, the timing couldn't be more critical. If a meaningful number of contract holders request physical delivery, the available metal may simply not be sufficient at current price levels. That's when markets tend to behave in ways that surprise even seasoned participants. What's particularly interesting is who appears to be driving this demand. Contrary to popular narratives, this doesn't look like a retail coin buying frenzy. Large institutional players seem to be stepping in aggressively. Recent filings from major silver-backed exchange traded funds show a substantial increase in holdings during the first week of December alone, pushing total reserves to levels not seen since early 2021. That kind of accumulation doesn't happen quietly or accidentally. Options markets are telling a similar story. Heavy call buying activity has been clustering around higher strike prices, notably in the 65 to 70-year range, with expirations extending into early 2026. This suggests that well-capitalized participants are positioning for significantly higher prices within a relatively short time window. These aren't small speculative bets. They look like calculated moves by players who expect meaningful upside. Then there's the shift in positioning from one of the most influential names in commodities trading. According to recent reports, JP Morgan's Commodities desk has reportedly flipped from a net short position in silver futures to a net long stance, something they haven't done in years. When a firm of that size reverses direction, it's rarely without reason. It doesn't guarantee a specific outcome, but it does warrant attention. Before going any further, it's important to be clear this is not financial advice. Everything discussed here is based on publicly available data and personal interpretation. Markets are complex, and outcomes are never guaranteed. Anyone considering investment decisions should do their own research and consult qualified professionals. With that said, there are 4 specific indicators that, taken together, can offer valuable insight into what may happen next. These are the metrics I'm watching closely, because when they begin to align, markets tend to move decisively. The first indicator is COMEX registered silver inventory itself. As of mid-December, this figure sits just above 19 million ounces. In my view, sustained levels below 20 million signal persistent tightness. A drop below 15 million would suggest the market is entering territory we've rarely seen in modern times, while anything approaching 10 million could indicate extreme strain. These figures are published daily by the CME Group and are easy for anyone to track. The second indicator is short-term silver lease rates, specifically 1-month leases. Lease rates reflect the cost of borrowing physical silver, and they tend to spike when metal becomes scarce. Recent readings have surged into the high 30% annualized range. Historically, readings above 50% have occurred only a handful of times over the past 2 decades, often during periods of acute stress such as the 2008 financial crisis and the early months of the pandemic. Elevated lease rates are a quiet but powerful signal that physical supply is tightening. The third indicator is the relationship between spot prices and futures prices, known as backwardation. Under normal conditions, futures contracts trade at a premium to spot prices to account for storage and financing costs. When spot prices rise above futures prices, it suggests immediate demand is overwhelming future supply expectations. Recent data shows spot silver trading unusually close to, and at times above, near-dated futures. Sustained backwardation lasting several trading days has historically preceded significant price movements within weeks. The fourth indicator involves regional price differences, specifically premiums on the Shanghai Gold Exchange compared to London spot prices. During genuine physical shortages, Asian premiums tend to rise as manufacturers compete for immediate supply. Recent premiums have been modest but positive, with brief spikes that suggest underlying tightness. Sustained premiums above 1 to 2% would be a strong signal of stress. Conversely, negative premiums could indicate easing conditions. When all four of these indicators point in the same direction, low inventories, high lease rates, backwardation, and rising Asian premiums, history suggests the market is approaching a tipping point. This alignment has occurred only a few times in recent decades, and each instance was followed by substantial price moves. So what are the possible paths forward? Based on historical precedents from other commodity squeezes, three broad scenarios stand out. The first is a full-blown squeeze, where prices accelerate rapidly in a relatively short period. In this scenario, silver could push well beyond current levels over the next year. The trigger would likely be inventories falling decisively below critical thresholds, combined with a large industrial buyer attempting to secure long-term supply. This path carries upside potential, but also the risk of sudden rule changes by exchanges, such as cash settlement options or emergency inventory measures, events that have disrupted markets before. The second scenario is a more measured advance, which I consider the most probable outcome. Here, silver continues higher but in stages, punctuated by pullbacks and consolidation. Contract expirations could force incremental short covering, while profit-taking and supply announcements temper the pace of gains. Prices might oscillate within a broad range as the market debates whether industrial demand can sustain elevated levels. The third scenario involves a correction and reset. In this case, silver fails to maintain momentum, retreats to lower levels, and establishes a new trading range. This could be triggered by weaker industrial data, substitution efforts by manufacturers, or a shift in monetary policy that pushes real yields higher. Precious metals tend to struggle when real yields rise. What makes the current setup especially compelling is the broader fundamental backdrop. Global silver supply has been running persistent deficits for years, with cumulative shortfalls reaching hundreds of millions of ounces. Mine production has remained relatively flat, while industrial demand, particularly from solar energy, electric vehicles, and data center infrastructure, continues to grow. These sectors rely on silver for its unique properties, and substitution isn't always feasible. Monetary policy adds another layer. Recent rate cuts and guidance toward further easing reduce the opportunity cost of holding non-yielding assets like silver. Historically, periods of negative real yields have been favorable environments for precious metals, and current conditions appear to be moving in that direction. The key takeaway is this: silver's recent dip and rebound weren't random. They were signals. With inventories tight, institutional positioning shifting, and multiple stress indicators flashing at once, the next few weeks could prove decisive. Whether the market resolves higher, consolidates, or corrects will depend on how these data points evolve. One question looms larger than all the rest. If registered silver inventories continue to decline at anything close to their recent pace, what happens when deliverable supply approaches zero? At that point, the exchange must either attract new physical metal with higher prices or alter settlement mechanisms. Either path would have profound implications for the market. This isn't just about charts or speculation anymore. It's about physical availability in a world where demand keeps growing and supply struggles to keep up. The coming weeks may determine whether silver enters a new phase altogether.